Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, this week is a good reminder that earnings season, it never ends.
Right, because NVIDIA reports on Wednesday. You also have Walmart and Target, not to mention a whole slew of economic data.
Which we haven't had in quite a while. So on that note, let's get to the biggest stories right now. In the nearly $19 trillion global ETF industry, stocks wavering right now as traders prepare for those NVIDIA earnings and that delayed jobs report set to be released later this week.
In just a few minutes, we will speak to John Maier of JPMorgan Asset Management on the firm's fourth quarter guide to ETFs.
And Grayscale, it tests the public markets as it files for an IPO under an administration more open to digital assets. All of that and more coming up. But as always, Eric Balchunas from Bloomberg Intelligence, he's here with us now. He's looking at the flows. Eric, what do you got?
Katie, Scarlett, I am. And we got a lot of flows, as usual, but even more than I thought. Last week was a bit shaky. I could feel some fear getting into the market. SPY had a over $60 billion day. That tells you some people are definitely having some real fears about the market feeling a little toppy. But ETF investors, no shocker, they're investing right through it. VU at $6 billion, again, ridiculous. Vanguard is now going to take in more money than any ETF issuer has ever taken in the history of time this year. And VU will be the single record holder. IVV, another 4, that's pretty good. Now, Treasuries, this is interesting. More on that in a second. And money into Qs, so looking pretty good. But let's look at the outflows. And some of this is negated by this SPY whopper of $6 billion. And then there's also some treasuries here. Bitcoin, a little rough patch for Bitcoin there with about $3 billion out of all the Bitcoin ETFs. So that's only 3% of all the assets only. We'll see where that goes. Now let's look at what I sometimes refer to as the safety dance chart we have, which is treasuries, gold, and low vol. I just put on here treasuries and gold because I did sense, when you see IAF at the top, that's pretty bearish to a degree. But gold has also been at the top all year. But if you notice, here's gold and treasuries. This is treasuries, this is gold. Gold is gone. People are kind of done with it for the last few weeks. Treasuries now are building up. And if you look at treasuries, they didn't do that much. So I think there's more money, Katie, going into treasuries with the nerves because gold also feels toppy. So it's a complicated situation out there right now.
Absolutely, Eric. Thank you. Let's keep the conversation going now with John Maier. He is Chief ETF Strategist over at JPMorgan Investment Management. John, great to see you in person.
Thanks for having me, Katie.
So let's start there. The fact that you are seeing this consistent bid into treasuries. I know that you recently released your fourth quarter guide to ETFs. Fixed income, a hot topic in that guide. So how do you explain the recent and consistent bid into treasuries? Well,
first of all, half of our flows this year have been into fixed income, actively managed fixed income ETFs. And what I have noticed as the Fed has reduced rates and there's expectations that they will lower rates more, potentially December, potentially in January, investors are looking to maintain their yields. So there was a lot of money in ultra short. Now we're still seeing money going into ultra short as well, but we are seeing more of a diversification to kind of step out on the duration curve, whether that be intermediate core plus. And I think it's all in the expectations that rates are going to go lower. And then investors who have this tremendous amount of cash want to deploy that cash or bring out some of that cash from ultra short into longer duration instruments. And I think that's what's going on right now.
So when you see that interest in going to a longer duration, is that mirrored in, say, the muni market as well?
The muni market is, investors are very tax sensitive. And if you look at two of our funds, JMST and JMUB, have about $10 billion in assets. JMUB is the largest actively managed ETF in the muni space. And we are seeing that good amount of flows and a lot of interest because they're looking to create that sustainable after-tax yield, which I think is important. So yeah, munis are certainly being a recipient of.
I don't know if it's the crypto influence, but I want to talk about JPST and the inflation factor. So here's the problem people have with general bonds. Forget money markets. Let's just go with the ag or ag-like products. JPST is trying to beat these benchmarks with not just treasuries, but corporates too. It's returned 3% annualized. Pretty good. But my crypto brain, which I'm growing half of right now, would say, well, but inflation's 2%, probably 3 or 4 really. So this real return is nothing. And I think that's where some people get frustrated with the bonds and they want something else that gives them a positive real return?
I mean, crypto is, I think it's a completely different category from JPST. JPST is something very conservative. It's an investment grade portfolio. So I would be hard pressed to compare it to crypto.
No, I'm just saying that it got me thinking about real returns much more. And so if the real return here, because the ag has returned nothing in real terms in 10 years, I think this is why bonds have underperformed a little bit in flows lately. I just want to say, like, if somebody were to say, well, 3%, what would you say about the real return? There's nothing you can do about it, I guess.
Well, I mean, what I think about is diversification across your overall portfolio, and you're not going to just be in JPST. That's going to be your cash-like. It's not cash. It's certainly not cash, but it's on a lower duration portfolio. And then when you move out to intermediate core of about 5%, you go a little further out, you get closer to 5.5%, 6%. You start laddering the fixed income portion of your portfolio, and that's only one portion of your overall portfolio. A standard 60-40 portfolio would be 40% or so. And that's diversification. And right now, when we are seeing valuations very high, particularly on the equity side, I think investors really need to focus on diversification. And that brings down your overall volatility in your portfolio.
Let's talk a little bit more directly about the credit space when it comes to ETFs, because I'm taking a look at the guide, and you write that 90% of high yield ETF assets are actually in passive vehicles right now. I know that, of course, JPMorgan has an active junk bond fund, but I wonder why that is. That's just because issuers haven't necessarily been launching in the active high yield space, or does that speak to maybe investors still having some hesitation around going into high yield in an active product?
Well, yeah, I think it's a bias. If you think about how the ETF world grew up, it grew up largely passive. So the active entrants have been later to the marketplace. So it's adjusting the investor to the new structure, full transparency, and making them aware that you can still operate just like you can operate a mutual fund, but inside an ETF. You have that liquidity, you have that transparency. And you know what? ETFs actually price the underlying securities. They were very helpful during COVID, whether it be investment grade corporates or high yield. The underlying market was priced by the pricing of the ETF. And that, I think, has accelerated the usage and understanding of ETFs. Also, it has helped the efficiency of the overall marketplace, whether it be high yield or investment grade corporates. It's made the fixed income market overall more efficient. So it's essentially getting the word out that you can operate inside the ETF structure more efficiently. The transparency, I think, is important, and its portfolio managers have kind of gotten over that leap. But I think it started off with the bias that it grew up passive, and now it's moving towards active. This year, 40% of overall fixed income flows, active and passive, have been into active. Similar number for equities as well.
You write about how there's an equification of credit markets, which I love because it's a way of thinking about credit that's familiar to stock investors. It's had a beneficial impact on liquidity. Do you see that more in the high grade space or in the high yield space?
I see it in both, actually. I see that because you can get that pricing for ETF at any given time. Now, you may not like that pricing, but you can get the pricing anytime. We have a great slide in the guide to ETFs looking at the underlying high yield market of volume of the underlying market, as well as looking at the 10 largest high yield ETFs in the aggregate. And you'll see that the volume is meaningfully higher, like goes up, particularly during periods of volatility. But the underlying market kind of trades like that. And it trades like that because it's often not traded. It's housed within individual accounts and institutional accounts. So I think that's the big difference. It's giving a pricing when the underlying market may not have a bid.
And just real quick, what's your take on the ETF share class coming? I know you guys have done conversions, you've launched clones. I think you are looking to do some of the share classes. What should we expect in the next couple months?
Yeah, well, I think it's still early. Obviously, final approval is not across the board. I think there's operational components that really need to be overcome, both on the issuer side as well as the custodian side. But it's a reality that's going to happen. It'll be interesting to see the evolution. I think there potentially could be unintended consequences both for the mutual fund shareholder as well as the ETF shareholder both positive and negative. So we'll see that over time.
Yeah, certainly going to be a giant topic of conversation in 2026. John, great to get some time with you ahead of then. That is John Maier of JPMorgan Investment Management. Now coming up, Grayscale files for an IPO. We'll discuss why the crypto asset manager is testing the public markets, even as other IPOs have struggled this year. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And given that we're already more than halfway through November, I thought it'd be a good chance to take a look at who is winning the race for ETF flows by issuer. It's either BlackRock or Vanguard, and this year, once again, it is Vanguard in 2025, taking more than $300 billion of assets. You can see that for several years in a row, it was BlackRock that had claimed the crown, but then the waters changed in 2020, and it's been Vanguard cleaning up since then. So we'll keep an eye on this chart. But let's also talk about the exchanges. We were having an interesting conversation with NASDAQ last week about how they're staffing up in anticipation of share classes next year. I spoke with the CEO of SIBO, and they're taking a different tack. Let's take a listen.
We're going to continue to pursue ETP listings, but, you know, one of the things we need to focus on is profitability also. And so, you know, having the largest number of ETP listings doesn't always translate into the bottom line and profitability.
We are staffing up our team to really ensure that depth. We're actually going to put out more headcount on the business side in the coming weeks.
So it'll be fascinating to see how that shakes up. But speaking of exchanges, let's talk about IPOs. Grayscale filing last week for an IPO. You know them. They're the firm behind GBTC, of course. They have about $35 billion in assets under management. GBTC is about $16 billion of that. All told, Scarlett, they have 40 products that are tied to over 45 tokens here. So it's going to be really interesting to see how this is received by the public markets.
Especially with crypto kind of in flux right now. So let's talk more about this with James Seifert of Bloomberg Intelligence. And when it does IPO, they've got the ticker GRAY that they'll be trading under. What you just point out to me, and I'm fascinated by, is this idea that someone has already come out with an ETF that'll be a levered play on Grayscale's stock overall.
Yeah, they filed for their IPO, and one day later we saw a filing for a 2X Gray ETF. They're moving quick now. I mean, single stock ETF issuers, they're trying to get out the gate as quickly as possible.
Got to respect the hustle, I suppose. But let's talk a little bit more about Grayscale and the fundamentals here, because we mentioned GBTC, but also the filing showed that they've seen overall a revenue drop. So what's actually going on?
Yeah, I mean, so the one thing I would point out is GBTC and ETH make up north of 80% of their revenue and assets. They're the Grayscale Bitcoin Trust and the Ethereum Trust. So one, there's been a little bit of outflows from those. So when you see outflows from there, it's going to dramatically hit their revenue. And overall, the money, some of that money is coming back to other products. They actually have really good tickers, right? So we just talked about their one ticker, it's Gray. They also have the ticker BTC, and they have the ticker ETH, which are the actual tickers for the underlying assets on crypto exchanges. So they do well there, but for the most part, they have high fee products, and when they see outflows, it's going to hit them. But most of the money's sticking around because they're kind of stuck there, I think.
GBTC, if I'm not wrong, still has $15 billion. That's probably making it a top 5 revenue generating ETF. So it's still, that's like a cash cow. But BTC is really low cost. I think it's trying to come up with a Dogecoin ETF in a week and be first. So Solana just came out first, XRP first. There's this whole Pandora's box now. Give us the state of play with getting out first for these other coins.
Yeah, I mean, so actually some of these issuers were handed a gift and some were really hurt by what happened with the government shutdown. There was these wonky ways that you guys have talked about to get these ETFs out first, and you mentioned it. Bitwise got BSOL out. That was the first Bitcoin Solana one. Grayscale was only a day behind, but they haven't really benefited in the way that Bitwise has. Canary got XRP out, did really well. So now that the government's reopened, it remains to be seen how many of these are going to be able to launch under that process, how many are going to come to market. But there's going to be hundreds of these products coming to market. So it's kind of unique in the sense that we don't often get a lot of pure play ETF issuers that are trading publicly. WisdomTree is one. But this is also a pure play ETF and pure play crypto ETF. And crypto right now, as you mentioned, not doing well. Like Gemini just went IPO. They're down 60% since their IPO pretty much. So it's not a great market to IPO, but they're coming to market. And the other thing I would say is DCG owns this, and the voting structure of this IPO, DCG is going to remain like the vast dominant voting structure. There's an A class and a B class, and DCG, Barry Silbert, it's basically a venture capitalist conglomerate. They're going to keep control and ownership. So you'll get like the financial upside potential, but you're not going to be able to vote or change anything if DCG doesn't want that to happen.
So the crypto as an asset class is not doing that well. Bitcoin has kind of struggled to regain that $100,000 level. If it continues like this, do you expect these ETFs to still debut regardless, or will they wait for a better time?
Yeah, they're going to debut regardless. I mean, like we said, we just watched XRP launch. It's down. It's in a bear market, arguably, over the last month and a half. It's definitely not great. And they still took in over $200 billion when they launched, right? Same with BSOL from Bitwise. That launch did very well. So these guys, they want to be first to market, and everyone's going to launch these things because you want to be out there in the market in the way that, like, if these coins take off and they start doing well, you want to make sure you have a product positioned to take advantage of that.
So why do you think, I mean, a company like Grayscale wants to go public? It's not unheard of course. You have a lot of publicly listed asset managers, but what's behind the urgency to hit the public markets?
I wish I knew the exact. I have a few thoughts, right? So for one, we know there was a lot of rumors that they were up for sale potentially at different times. Barry Silbert ran into issues with, and DCG ran into issues with Genesis Trading. They had to sell CoinDesk. DCG was the owner of CoinDesk. This is just more monetizing this asset. So I don't know how much of a rush there truly is, but they definitely made a lot of changes at the actual like company level of Grayscale. They brought in a lot of people that you could tell they were gearing up to possibly go public or get sold.
A new CEO.
A new CEO. So they're ready to IPO here. It'll be interesting how the stock trades, but it's going to be a pure play crypto ETF firm.
Right. James Seifert, thank you so much, keeping us up to date on the latest in the crypto space. He is with Bloomberg Intelligence. Now, still ahead on ETF IQ, we speak to Dan Ahrens of AdvisorShares on its psychedelics ETF next. Eric has a whole song and dance about it. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And it's time for today's drill down where we focus on one ETF. Eric, what do you got?
Today, Katie, we have a really interesting thematic ETF, the AdvisorShares Psychedelics ETF. This is basically a thematic play that invests in companies, it's all healthcare, it's all pharma and biotech really, that make the drugs, not just cannabis, but now you're into things like MDMA, ketamine, mushrooms, basically some of the party drugs are now used to treat depression medically for people, and there was a lot of hopes this would be a big business, but it hasn't really taken off yet. Here's 18 million in assets. It does charge 1%. That's a bit hefty, but if this thing rips, it's going to really rip. I'll show what I mean in a minute. It's 5 years old, 4 years old. Let's look at the cross-section of the holdings. Like a typical theme ETF, you're going to get different countries here, but predominantly U.S. And then you can see here, biotech and pharma is everything. And the volatility, though, expect it's about 3 times more volatile than the S&P. But again, with themes, I think you want that. Let's look at the performance of this. I threw in the S&P and I threw in MJ, which is the popular cannabis ETF. These are both down so bad. I mean, this thing launched right into like its personal hell. I mean, it's down 80%. So is cannabis, though, and the market's up 59. Now, some people out there, contrarians, might be like, well, maybe it's time for a little pop. We'll see. I think it needs some kind of a news catalyst, Katie, but tough times so far for this one.
Absolutely. Eric, thank you. Joining us to talk about this ETF is Dan Ahrens. He is a portfolio manager over at AdvisorShares. Dan, great to have you with us. Let's talk about performance because like Eric mentioned, 3 straight years of double-digit declines. Then you take a look at year-to-date performance in 2025. This ETF is higher by about 62% on a total return basis. What changed in 2025?
An awful lot changed. A big one was getting RFK into the head of the HHS. And then you just have to look at an awful lot of public perception, acceptance for alternative healthcare treatments, getting more and more acceptance worldwide. And also these psychedelic treatments, alternative healthcare treatments for traumatic brain injury, untreatable depression, PTSD, all sorts of things, have been moving through their FDA trials. And these very new microcap companies that a few years ago weren't getting much play at all in the public perception and among investors, now are moving into, Series 3 trials, Series 2 trials, FDA, and moving quite along. So after getting beat up badly for 3 years or so, in the past year, they're really getting some play. And when you look at their prices, I still think they have a great deal of upside, even though we've had a nice year to date so far.
So like biotech stocks, many of them are probably unprofitable because they are building out their pipeline and building out what they can offer. And you talk about this progress on clinical trials. Are these candidates for being acquisition targets for big pharma or at least somewhat bigger pharmaceutical companies, given that those companies need to refill their pipeline of drugs?
Certainly. And we've seen a few acquisitions among these companies, big pharma buying up these microcap psychedelic specialty companies. Now, I think we all know those things are impossible to bet on, impossible to pick the winners of, but that's an important thing about having an ETF with all these companies making up the portfolio. It's really nice when one of them gets acquired for a nice premium buyout price.
And Dan, Eric here, just in about 40 seconds, what is the total market for this? And how much of that market is cannabis versus those other drugs?
Well, nothing to do with cannabis here. And that's what we always have to completely explain and set apart. A lot of cannabis stocks are based on, one, you have medical cannabis, two, you have states that have adult use. There's nothing like that in psychedelics. A few areas have decriminalized, things like that. But these are real NYSE and NASDAQ listed biotech companies doing legal business, FDA trials of real treatments and real drugs. They just happen to be using psilocybin and ketamine, MDMA, and others. I think there's a huge market for it, and this is still just in its infancy.
All right, Dan, unfortunately, got to leave it there. Really enjoyed this conversation. That is Dan Ahrens of AdvisorShares. You can read all about this drill down plus the latest in the ETF industry when you subscribe to my weekly ETF IQ newsletter. But that does it for Bloomberg ETF IQ, the television show. I'm Katie alongside Scarlet Food and Eric Balchunas, and this is Bloomberg.